Today, credit booms, but what does it really tell us? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Steve from Canstar. Hi Steve.
G'day Martin.
Great to have you back on. Happy New Year. And
Happy New Year to you.
So much to talk about. You put out a release last week based on the latest statistics from the ABS, which really called out a significant boom in credit. And I guess my question to you is, what does this tell us?
Well, look, home loans are up for the first time in 6 months. That sounds crazy when you hear of the boom we've had, but it's an overall increase on the month before, and it's seasonally adjusted, so it's not influenced by any of that. And look, I think it tells us that 2022 is going to start the same way that we ended really 2021, and that is with a booming property market.
I guess one question to my mind is, APRA brought in those changes to the buffers, right? And it actually hit in December. So in other words, November was the last month on the old basis. I wonder whether that has anything to do with it.
Look, I think it will have some impact, but what I think it might do is kind of reshuffle the deck chairs, unfortunately. And I think the people that will be hit hardest by those buffers are likely to be first home buyers who are getting in on small deposits, and they're younger, so they have potentially lower incomes and they have bigger loans. And they're the ones I think that are going to be hardest hit by the increase in buffers. Now, I'm sure that's not really what APRA is wanting to do. APRA is saying we want a better quality, we want to make sure that the system's safe, we want to make sure the banks don't fail, there aren't big write-offs, all that sort of stuff. But the unfortunate impact is that first home buyers who are already doing it super tough getting into the market are going to feel it even more.
Absolutely. Whilst investors seem to me from those statistics much more on song at the moment.
They are. The good thing with investors is that they have existing equity in a property, and that property has gone up 21% over the last 12 months. So they're saying, well, I can afford to borrow money, plus I'm likely to have a bit more deposit, plus I've got a larger income and I'm supplementing it with rent. So they're doing it a lot easier. And last month's, November's data on lending was a full 90% up on November 2020. Now that tells you that this is a mega boom and that it's driven by investors and that they're creating up first home buyers.
And of course, it reminds me a bit of 2017, when in fact APRA ultimately had to intervene on the investment side of the house. I wonder whether we might see something to do with that, because really this boom on investment isn't necessarily healthy, is it?
No, it's not. And I think it's not if risk is being taken. And I think risk is being taken. People see equity go up in their house and they say, well, this is burning a hole in my pocket. This is a key to wealth. So one, investors are taking big risk. And then socially, there's a whole group of people who are not benefiting from a property price boom. And they're people saving for a first home, or people who've decided that they're not really in the market for a house period and can't afford a house. So it's socially got impacts that I don't think are very favourable. APRA did say when they brought in this latest set of buffer changes that this might not be the last of those macro-prudential measures, and I don't think it will be. And I think if we see the first half of 2022 looking like 2021 with runaway property prices and massive clearance rates and all that style of thing, I think APRA is going to say, look, we've got to do something to slow it up.
And they have been signalling they might do something. And of course, a lot of the analysts say, no, they won't. They just sort of, waving a sort of a wet lettuce at it and, hopefully it'll work itself out. But if those numbers were to continue, they would have to do something, wouldn't they?
I think so. I think it just has too big a repercussion, in particular socially. It's just the whole group of people that will look at this and say, I will not be able to get into a house. I'm giving up on that. And what does that mean when they hit retirement age in 30 or 40 years' time? That means that somehow the community has to work out a way for them to live. So I just don't see that APRA can do nothing unless the market takes care of it and it slows up. But I just don't see it happening. You know, we did a survey last year, our Consumer Pulse survey, and 62% of respondents are saying they believe property prices are going up, and only 12%, only 11% said no, they'll go down. Now that says that for the immediacy of 2022, the sentiment is so strong that it's likely that we'll see property prices to continue. So I don't think APRA will have that get out of jail card free.
No, and whilst they say they've got no direct accountability for house prices, and as RBA also says the same, nothing to do with us, that the fact of the matter is there are consequences from this in terms of financial stability. You know, if people are actually over leveraged, particularly in the current environment where incomes are still a bit wobbly, particularly with COVID and those things, people who are highly leveraged are going to be potentially at risk if things go a bit pear-shaped. So from a risk perspective, as well as from a social perspective, APRA probably really does need to do something.
I think so. First home buyers will be saying, oh, forget this 20% deposit thing. You can't be serious. We're not ever going to get to that. If we try to get to 20%, we'll be just chasing ongoing property price increases and adding a year every 3 or 4 years to the time it takes to save. So they'll say, forget that. We'll get in on 5% on one of these special deals where the bank pays for leverage for lender's mortgage insurance, or where the government meets it, or whatever, and we'll be taking risk. We'll have a much bigger loan, we'll have much less equity, and lender's mortgage insurance doesn't cut the risk for them. They're up for more because they've paid the deposit and it's been rolled into the loan. So it increases the risk for first home buyers, and it increases the risk for investors and everyone else. So, it's income that's the issue. Income's the big deal. Let's say the property price corrects by 10%. Well, you could go into negative equity, which is a very bad feeling, because then it's the bank's problem as well as your problem. But if you've got income to keep the repayments going, then things will probably sort out. But if you don't have income enough income because you've taken on too big a loan, then a correction can be catastrophic.
Yes, and certainly in my surveys, I do see some people who are very overextended and their incomes have not grown at all in the last 3 to 5 years. And whilst there are many people talking about pay rises, etc., the evidence so far in Australia, unlike perhaps the US, is there isn't really much news of pay rises.
It's all in sectors. We recruit and hire a lot of tech people and a lot of digital people. And if you're hiring those people, you know that there's a boom in salaries and wages, absolute boom for those sectors. But if you work in hospitality, entertainment, healthcare, a lot of the big areas, retail, I'd say, there's no salary increases, no wage increases in those sectors for years. And it's very sectoral. We've got some real winners and we've got some big losers. And in the past, one of the things that we used to see in the past for generations is that if you took on debt and got into a house, in time, inflation would take care of it. The value of the house would go up, your wages would go up, and in time, you said, oh, well, I'm glad we did that. It looked a stretch at the time, but it's all worked out. We haven't had that scenario for 10 years now. So we haven't had wages going up. We have had house prices going up, but not wages. So inflation has not taken care of it this time around.
No, absolutely. And, the get out of jail card that they had in the early 2000s, which was significant wages growth, is just not happening. And I don't see it happening for many people, particularly those who are actually stretched, because a lot of those people who've got those very large mortgages relative to income are working in those sectors where there's no real income growth. And, of course, cost of living continues to rise.
It does. And all right, the Reserve Bank's waiting for for inflation to return to that 2 to 3% band, but they use a different style of measure, and they are looking for sustainable growth before they put interest rates up. And they really say, look, we're looking for 2 to 3% for wages. So they look at the average wage and has that gone up? When they look at inflation, they cut a whole bunch of things out that people actually say, well, hold on, that's hurting me right now, and it might not be sustainable, but it's there right now. And people see it in when they go to the Bowser to fill up the car, and when they go to the supermarket to fill up the trolley, they find that the dollar is not going as far as it was by a long shot. The other thing is that during COVID, there were two speeds going on. Some people saved a lot more and reduced debt. Other people took on a lot more debt. And those that took on a lot more debt took it on big time. And I'm talking about not home loans, but personal loans, credit cards, and that style of thing. So they're behind the eight ball even then. You've got to clear that sort of debt before you get serious about houses.
Absolutely, and a lot of that debt has a much higher interest rate attached to it. Credit card interest rates hardly came down at all for many people, and personal loan interest rates are extremely high. And you know, again, in my surveys, what I tend to see is those people who are stretched on the mortgage front are precisely the same people who have multiple credit cards and multiple personal loans. So they're actually debted out, and it gets to the point where it's very hard to make it all work.
It is. I looked at the average credit card rates, and even for non-rewards cards, I've got it written down somewhere. I won't look for it. Even for non-rewards cards, it's something like 19%, the average rate. That's not for cash advances. Add another 3 or 4% on for those. So it's a massive rate. If you are unfortunate enough to be in the situation where you're carrying debt on your card, do your very, very best to get into a rate below 14%, because they're round, and at least you'll be putting part of your repayment towards reducing the debt. Whereas if you're stuck on a card at 21%, you are paying just basically interest, and you never get out of the debt. You just got to put too much cash in to get the debt down. So get into that 14%, 13% region, not the average up over 20%.
No, it's interesting. Many people that I survey have no idea what interest rate they're paying on their credit card, which is another problem, right?
Yeah, and the other problem is, Martin, that, it's deliberate debt when you go into the bank or the ATM and get a cash advance. That's deliberate debt. You thought about it and you said, I need this cash for whatever purpose, and I'm going to get a loan effectively from the bank that's pre-approved because I've got a limit approved. When you spend money on your card, it's not necessarily premeditated. It's accidental debt. You know, you've gone out and spent, you've gone a bit too far, you got carried away because there's been no friction, it's been too easy to spend, and you're stuck with a debt now that you can't repay within a few months, and you're up for this exorbitant interest rate. So see, it's not even as if you made a decision to take on the debt with credit cards.
No, that's right. And of course, the point is that once you get into debt, every transaction that you subsequently put on the card incurs more debt, because the way it works is you pay off the oldest first.
Right from day one. Yep. No, forget about this interest-free days, which used to be a big selling point of credit cards. It works for people who pay it back in full on time every month, but not for anyone else.
Yeah, so a very important New Year resolution warning there. Check your interest rates on your debt. And by the way, my own view has always been that, just putting more debt into the system to try and get through isn't going to solve anything for people, because basically if you're doing that, then you've got a more substantive problem, which is that your income and expenditure is actually out of balance. The only way to solve it is to look harder at what you're spending your money on.
Yeah, I mean, you look at international affairs and look at the Greek crisis those years back. That was all about spending too much, and debt was too easy to get, so that when they hit the wall, it was actually not a wall, it was a cliff of falling a kilometre. In your household budget, it's just the same. Yeah. If you're spending more than you're earning, then you're increasing debt. And when you finally get to the point where credit's not available, you have hit the wall and you're in trouble.
And one of the things that people often say, well, interest rates are really, really low, so therefore the amount you have to pay back is actually a lot lower than it used to be, right? But 2 points there. The first is, of course, the average debt's a lot bigger. And secondly, a lot of the interest rates are still quite high. So that really doesn't cover it very well. Yeah,
it doesn't with credit cards. That's right. I mean, with home loans, sure, you can make that argument. And you know, if you're paying more than 2.5% on your home loan at the moment, then you're paying too much. And you know, there are 119 loans on Canstar that are below 2%. So you know, you're paying too much if you're above that. But you can make that argument that, you know, debt's cheap, so you should be going into debt. But then that's got to be good debt, not bad debt. And good debt is where you've taken on debt into an asset or an investment that will appreciate or make a good return for you. Bad debt is the other stuff that you've incurred because you're spending more than you're earning. So you can't make that argument at any time for that. And you've got to be careful with that argument anyway, because you and I have been around long enough, Martin, to know that things that go down go up again. And interest rates are a classic case, and we will have rates up around 8% again at some time. It's not going to be for a few years now, but they'll be up there sooner or later.
Absolutely, yeah. Interest rates will go up, and people are going to find it very painful. Last question then, in terms of interest rates, what about the savings side of the house? You know, people have been talking about, well, interest rates are on the way up. I don't see a lot of evidence yet that savings rates have really recovered from their lows.
No, they're not. We didn't do our usual tracking in December. We've got tracking for January. Nothing much happened there. Even though some fixed rate home loans went up last week, which is, you know, I guess they're back at work and hit the home loan button again. But no, you're right. Savings rates, they're rock bottom. If you're in a savings account, you can get up to 1.35% on a bonus account. Got to get the bonus conditions for that. But the average rate is, you know, 0.19% or something. It's derisory, frankly, and you sort of might think, well, so what?
Yes, absolutely. And the problem there, of course, is that many people are reliant on income from those savings. It's another pressure. And so in some cases, then they have to go and reach for debt to try and actually bridge the lack of income. So, you know, there are a lot of pressures on a lot of households at the moment. And you know, if you think about it ahead, it is likely that we're going to see interest rates rising at some point, right? The RBA probably won't want to put rates up anytime soon, but the international scene with the Fed is that rates are going to rise, and we can't necessarily insulate ourselves from that completely, can we? No.
If we try to insulate ourselves from that, we'll hurt the economy because the Aussie dollar will go up too high. And you sort of think, well, all right, interest rates going up, bad for the economy, share prices fall as well. But the other side of it is that when the Aussie dollar goes up, then our import competing industries and our exporting industries really do it tough. So we're in a situation where it's sort of like a no-win. If the rest of the world goes up, ultimately we have to and follow suit. We can't be too out of step. And New Zealand's already gone up. The Fed's, you know, sort of looking at inflation's out of control. So, you know, they'll go up, and not by 1 or 2%, I'd say. They'll have to go up a bit more than that. So we will see interest rate increases, even if the Reserve Bank doesn't move. I think you can expect to see a home loan rate go up sometime in the next 12 months. It's just that there's too much pressure. All of the variable rates have gone up, whether it's 1 year, 2, 3, 4, 5, and variable rates will start to go up, and probably go up before the Reserve Bank moves. It's just that the cost of funding will go up eventually. So I just don't see that people should expect to be where they are today with interest rates.
Yes, and of course the term funding facility, the very cheap money from the Reserve Bank, will have to be paid back by the banks, which means they need more expensive money to replace it. International debt markets are already going up, so the chances are the banks will probably start moving the rates even more before whatever the Reserve Bank decides to do or not do.
Yeah, I think there'd be no choice. I think there'd just be too many pressures on the banks in terms of funding. You can't expect banks to start lending at a loss. They're sure not making a loss on your home loans at the moment, but they're not going to take that sort of they're not going to carry a real contraction in their margins just to hold off until the Reserve Bank moves. They'll move before the RBA.
So I guess as we come to the end of our chat, the first one for the new year. What will be the best New Year resolution for our viewers in terms of their finances from your perspective?
Yeah, that's a really good question. I mean, I don't think there are a couple, and you know, I do these, or some of them anyway. One, I think if you have debt, work out a way of getting out of debt. Now, I don't mean home loans, I mean credit cards, etc. If you have debt, work out a way to get out of that. If you don't have debt, work out a way to save a bit of money, put it into your home loan to get that down, or into savings to build a buffer. Because we saw a lot of drawdown of buffers during COVID, and the people that didn't have a buffer ended up in debt. So, start thinking ahead. COVID might not be behind us. We hope it is, but anything can happen. So those two things. Now, ultimately, what those things mean is that you have to have a budget where your income exceeds what you are spending. Give yourself a bit of fun money as well, but also then say, all right, that means I want to put away this many hundreds of dollars every month, and stick to it. Don't touch it. It's money there for a different purpose. And the other thing is to help you with all of that, get into the right interest rates, get low rate loans, and get as much as you can for your savings.
Absolutely. So, just to build on that slightly further, Steve, I would suggest that everybody should just go through their statements or go online and find out what the current interest rates are for the mortgage and the credit card and the savings accounts and the personal loans, right? Write them down, right? So you know what they are. And then go and look at Canstar and see what the best rates are, because the chances are you're paying way too much.
Yeah, for everything, Martin. People, I shake my head when I see this. People run around at Black Friday sales and Boxing Day sales to get the odd bargain. And yet when it comes to their finances, they don't compare. They just sit there and renew insurance policies without actually getting comparisons, sitting on a home loan interest rate that was negotiated 4 years ago without realising that they're paying 1.5% too much. All of these mistakes that they make in finance that are much bigger ticket items and don't affect your lifestyle at all. Once you've gone through and put a little bit of effort into switching, your lifestyle is just as good as it was. You don't have to tighten the belt, and you've saved a lot of money. People don't do that. So, look, I agree. I shake my head that people don't do this. I know it's not interesting, it's not fun, but it's just so worthwhile. You work hard for your money. Don't just give it to the bank.
You've got to make it work for you, not for them. And, actually, it's not a huge amount of effort, right? You just got to go through the discipline. I always say to people, New Year resolution, beginning of the year, just check to see where you are on your various rates. Chances are you'll be able to save yourself some money, and then later in the year you can take a holiday.
Yeah, well, that's right. I was put on the line a couple of weeks back at an interview, and the interviewer said, "Well, which have you done this year?" And I said, "Well, I actually have. This year I did a pretty good job. The last 18 months I did my home loans, my health insurance, my house insurance, and my superannuation. I reviewed all of them and switched a couple of them and renegotiated with the others. So it's something that I'm actually practicing what I preach. Can't say I do that every year, to be honest, but you've just got to do it. And the reality of it is that it's easier to do now than it used to be, because all of the information's online at one place when you want to do the comparisons of Canstar, and you can go online to a new provider, the one you've chosen, and they take care of the switching for you. You don't have to front up at the bank and try to close accounts or anything. You just go to your new provider and say, this is what I want to do. They approve it, and you sign all the authorities, and they take care of it. It's never been easier.
Absolutely. You just got to take the initiative and grasp the nettle, to mix my metaphors a little bit. But it does make a difference. And I come back to this thing. If you can do those things, then you can basically save some money without making those hard decisions about, I can't spend this or I can't do that, whatever, right? Because basically you're just paying more than you should for what you're doing. It is money for old rope once you've done it.
It is. It'll spend the money on yourself, not on the bank.
It's great advice, Steve. Thank you very much for your time today. I'm sure we'll be picking up this conversation through the year as things develop. But New Year resolution for everybody, save some money.
Exactly.
Thanks, Steve.
Okay, Martin. Cheers. Thank you.
Cheers. Bye-bye.